Hello, very good afternoon to all, and welcome to today's Daily Dose of Market Insights. I'm Calvin here again. Very good afternoon. Today will be Wednesday, the 26th of February 2025. So, as usual, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick recap first. What has taken shape yesterday in today's Asia session as well, early Asia session as well, in terms of the news flow, economic data release, and as well as the respective intraday cross-asset performance before we jump straight into today's intraday technical outlook on the major stock indices, the major FX pair, and as well as the two key commodities, gold XAU/USD and West Texas crude oil. So let's start with the key economic data release that took shape yesterday was the Conference Board US Consumer Confidence Index. So why this particular index is important over here, because we know that consumer confidence represents the state of future US consumer confidence mindset in terms of it will drive retail sales, which eventually will drive the services activities in the US, which eventually contribute close to 3/4 of US GDP growth. So market participants are watching this one pretty much closely. Why? Because last week we have the flash S&P Global US Services PMI data that contracted for the first time in almost 3 years, represented a lackluster services activity sector in the US due to uncertainty of US President Trump trade tariffs plan against the rest of the world. So this has been hit badly on the latest consumer confidence data as being compiled by Conference Board. Because just have a side note, in US there are actually two consumer confidence data that we take note of, but they're being compiled by different organizations. Yesterday one was Conference Board. The other one is University of Michigan. Both of them has equal similar weightages that they could impact the various broad-based cross asset classes as well. So now with that, let us dive deep into the figure. So what we could see over here is market is expecting a slightly higher figure of 102.5. Yes, nevertheless, it's lower than 105.3, but it came market, the actual numbers actually plummeted much lower at 98.3. So if you were to look at the Conference Board website over here, they also have a brief that was actually being wrote. I do not want to actually go much in detail, but the key thing is that if you look at the trend of the consumer confidence index, that number that I just flashed earlier on, the way it drastically dropped this month itself for February towards the below the 100 level is actually the lowest level since almost about 3 years. And if you look at from a technical analysis perspective, right, this doesn't look good in terms of the trend. Very clearly a series of lower high and now threatening to break below this major ascending trend line support level itself. So it seems to us that this particular consumer confidence index, the trend seems to be now translating into a potential multi-month downtrend. And usually once you start to see a very steep fall on the consumer confidence index, that actually prelude previous official recession period in US that is shaded in gray over at the chart over here. This was during the great financial crisis, Lehman Brothers explosion, and this was during the COVID-19 scare as well. So something that because of this, that actually transpired into further weakness on the major US stock indices. So you look at the major US stock indices yesterday, it continues to plummet, especially those that are more related to the mega cap and AI-centric S&P 500, which is down negative 0.47%. The Nasdaq was the worst hit because they are much more heavily weighted towards the mega cap, with the likes of Apple, Nvidia for sure. Later I'll touch more about Nvidia. Why? Because we do have a risk event that's surrounding Nvidia later on. Nasdaq 100 that is down negative 1.24%, the worst performer. The Dow Jones Industrial Average managed to survive slightly because of several defensive NIM. The healthcare stocks has managed to help well against Dow Jones Industrial Average. Later I'll touch on the S&P heat map. You're able to see why. The Russell 2000 also down by negative 0.38%. So if you look at the S&P heat map over here, for sure, you see a deep red concentrated again on the second consecutive day on the semiconductor industry within the technology sector, where Nvidia is down by negative 2.8% ahead of today's key earnings announcement of Nvidia. And why is it important? Because Nvidia is the second biggest weighted stocks, market cap stock in the S&P 500 and the Nasdaq 100. And why the Dow Jones Industrial Average managed to outperform? Because there's this United Healthcare. United Healthcare is up by 1.92%, and United Healthcare is the highest or biggest weightage market cap stock in the Dow Jones Industrial Average. So that actually explains why the Dow Jones Industrial Average managed to kind of less scattered yesterday. All right, but what's interesting over here is that it also came in within our expectation. Right now is that the Hang Seng and the China related stock market or stock indices continues to outperform very well. So if you look at over here, is that despite the fact that lackluster performance on the major US stock indices as a whole, the Hang Seng Index and the Hang Seng Tech Index continues to show stellar performance today, up by 3% for the Hang Seng Index. The Hang Seng Tech is up by 4.4%, and the HSCEI, which is the H shares or the China's shares listed on the Hong Kong Exchange, is also up by 3.28%. So what I could continue to see that this positive divergence performance that has taken shape since the late January or during before the start of the Chinese Lunar New Year until now, there's this outperformance of the Hang Seng indices. That means, i.e., we're talking about that is the proxy for China's stock market performance against the major US stock indices, and as well as against the majority of the rest of the world, that continues to shine as well. And one thing I want to highlight over here is that the European stock market continues to be pretty much a defense to be pretty much unscattered as well so far by US President Trump tariff trade, where the DAX or the German DAX managed to continue to trade unchanged, basking in on the limelight of this new coalition government that's going to be formed by the conservative in Germany parliament, but excluding the far right AFK far right party, that actually promise a more potential, we call it a government infrastructure spending plan for Germany, proposed by the new coalition government in the Germany, which is the recently concluded with Germany election result on Sunday, that actually boost a bit of optimism to the German DAX. So later I'll touch on the German DAX index over here. But what's interesting over here is for gold, despite the fact that due to this stagflation risk that is still inherent, there's some kind of short-term positioning that is taking place in gold, not really but related to fundamental, but more technical driven, that we start to see gold breaking below the 2004 short-term pivotal support that we highlighted yesterday. So gold right now is trading almost unchanged at 0.09%. After during the start of the Asia session, it managed to fight back above 2,900 level. So later I'll touch on some of the key intraday short-term technical aspect of gold, which has started to deteriorate based on yesterday price movement. There's a risk of kind of technical positioning at play, or potentially I would say there is a bit of unwinding of late levered longs in the gold market that causes this pullback that takes shape yesterday. All right, so over at the FX space, I want to highlight is that FX market continues to trade rather mixed over here. So yesterday we see the euro dollar and the sterling dollar gaining strength against the USD, which came pretty much in line with our expectation, hitting our first resistance level that I highlighted in the short-term intraday technical outlook on the euro dollar and the sterling dollar. But what's interesting over here is that the Aussie dollar, within our expectation, continues to remain weak against the dollar. So this chart itself is a 5-day rolling performance chart of the dollar against other major currency. That means the dollar is the base currency. That means $1 equals how many Canada dollar, $1 equals how many Aussie dollar, $1 equals how many Kiwi dollar, and $1 equals how many euro and sterling dollar and whatsoever. All right. And what you could see over here is that the dollar strength is more pronounced on the CAD itself, the dollar CAD. So yesterday I highlighted one particular FX cross play to play will be the CAD yen. We also collapsed within our expectation. So later I'll share on other FX cross play to take a look at as well, into taking into advantage of this divergence, not very clear dollar strength performance yet across the board. Okay, it's a bit of mixed bag here and there, but we start to see the commodities currency, the CAD and the Aussie performing underperforming against the US dollar in the past 2 days based on this 5-day rolling performance. So given the strength of the dollar CAD that is the strongest right now, the dollar Aussie also managed to get dragged up as well. That means Aussie weakness. Why? Because the Aussie and the CAD are considered as intercorrelated related play by their labeling of it as a commodities currency. And yesterday I explained why the dollar CAD is so strong. That means, or the CAD is so weak, because US President Trump on Monday highlighted that he will continue to push through on 4th of March the 25% US tariffs targeted on Canada export heading to US, because it seems to us that there is a lack of negotiation, a breakthrough between US and Canada. So earlier on at the start of this month, Trump actually gave a bit of cooling period on 1 month period, and the cooling 1 month period will end on next Tuesday on 4th of March. So market is expecting the tariffs to actually be imposed on 4th of March against on Canada exports heading into US. So that actually explains the dollar strength movement against the CAD and dragging a negative feedback loop against the Aussie and the Kiwi dollar as well. All right, and what's interesting over here is that yesterday we do highlight, yes, we do have a bearish bias on the dollar yen, and the dollar yen hit the first support level, can't break through and manage to shape a bounce. And you see the dollar yen right now is now trying to play a catch-up play as well to cover its earlier underperformance gap against the rest of the other major dollar pair. So there could be some signs of another mean reversion rebound, at least in a short-term intraday basis, that could play out on the dollar yen when I touch on the intraday technical outlook chart of the dollar yen. And overall, let's take a look at the market expectation on the US Federal Reserve monetary policy going forward based on the CME Fed Watch 2. So on the CME Fed Watch 2, despite the fact that we have a rather lackluster or terrible conference board consumer confidence data, the market Dow doesn't change much. They are still expecting the Fed to remain on hold for the upcoming meeting, which is the next one will be at 19th of March. 4.25% to 4.5% means no cut at all. It's a high chance. Why? Because it's 96%, rather high. But if you look at the aggregated one, where the CME Fed Watch 2 take into account of the various different maturity month of contract for the Fed Funds futures market contract over here, market participants in the Fed Funds futures market has started to price in an earlier interest rate cut this time around. Previously was in July and September, and this time they push up slightly higher, 2 months higher over here. Quite high chance, a 76% chance of a 25 basis point cut potentially to come in on the 18th of June 2025 FOMC meeting. Okay, to bring down the Fed funds rate to 4.4% to 4.25%, and the next meeting potentially will come. The next cut will potentially come in October as well. Previously, it was priced in either in December or January next year. Right now, there's a high chance of 85% chance to come in on the much earlier on the 29th of October meeting. So net overall, market is still expecting 2 interest rate cuts so far by the Fed before 25 ends. The only expected over here is that they push up the calendar to expect these 2 interest rate cut to come in much earlier as compared to the previous week or day before the release of yesterday's conference board consumer confidence data. So overall, market seems to be now have a tough balance between how far, how much, or how soon the Fed will cut, taking into account of the uncertainty surrounding US President Trump, rather hawkish or sometimes lukewarm and sometimes optimism trade tariffs plan against the rest of the world or against US major trading partners. All right, so with that, now let us now dive straight into the short-term intraday technical outlook on the various broad-based cross asset classes that we share on a daily basis, starting with the FX market first. And before that, as usual, let me expand my screen. All right, over here. So this should be looking fine right now on your screen. So let us start with the FX market. Okay, starting with the euro dollar over here. Okay, so on the euro dollar, yesterday we do have a bullish bias. So the bullish bias hit our first resistance level 1.0530 before trading back down in today's Asia session right now. And while it's trading back down in today's Asia session, and as we are speaking right now, the hourly RSI has started to shape this kind of bearish divergence. All right, a bearish divergence on the hourly RSI, and represent a lack of upside momentum in yesterday's push up during the US session. So with that, there is actually a high risk right now on the intraday basis. The euro dollar may do a minor, we call it pullback or setback scenario, to potentially revisit the 20-day moving average. All right, so with that, we will flip to a intraday bearish bias for today, 1.0530 short-term pivotal resistance. Two key levels to watch on the intraday basis as we head into the European session pretty soon. 1.048, a breakdown below it exposes 1.0450 slash 0440, which confluence with the 20-day moving average as well, coming pretty soon to it. Only a breakdown below 1.0440 potentially may see the extension of this minus pullback or setback scenario on the intraday basis to expose the next near-term support level at 1.0360. Graphically, is the minor swing low of 13th of February and 14th of February in terms of Fibo retracement taken from the last push up from the low of 3rd of February all the way up to yesterday's US early Asia session high. That will actually be close to 38.2% Fibo retracement if I were to. Let me see. Let me put it on the center. Yeah, you're able to see. Yeah, 38.2% Fibo retracement. Okay, which is also close to the 50-day moving average as well. Only a sudden U-turn and the push-up with an hourly close above 1.0530 will invalidate today's intraday bearish bias or that potential minor pullback setback scenario to see the continuation or the extension of this mean reversion rebound to resume for the next intermediate resistance to come in at 1.0565 and even potentially 1.06 figure level, which is the minor 1.06 figure, which is the minor swing high of 18th of November and 6th of December last year. So this for the euro dollar, flipping due to a bearish momentum that is being reflected on the hourly RSI. We will flip to an intraday bearish bias for a potential setback scenario using 1.0530 as my short-term pivotal resistance level. Onwards next will be the sterling dollar, also showing a very similar fate as well, where the hourly RSI has started to shape out a bearish divergence condition, indicating the lack of upside momentum on the intraday basis for the sterling dollar. So I'll be using 1.2720. First resistance level to watch will be 1.2688. 1.2720 slightly higher will be my short-term pivotal resistance level, and also the upper boundary of this ongoing bearish ascending ridge-like configuration that has taken shape in this ongoing corrective rebound phase within its major downtrend phase that is still intact because it's still trading below the 200-day moving average right now. All right, so potentially there could be a form of minor setback that could take shape today on the sterling dollar. First support level to watch on the intraday basis, 1.26 figure level. A breakdown below it exposes 1.2570 slash 2540, which also correspond to the 20-day moving average pretty soon as well. Only a push up and an hourly close above 1.2720 will invalidate today's bearish intraday pullback setback scenario to see the continuation of this mean reversion rebound sequence within its major uptrend to test the 200-day moving average, also conferencing with the next graphical intermediate resistance zone of 1.2780 slash 1.2810, which is the minor swing high area of 6th of December and 6th of December as well, 12th of December, and as well as the 1.236 Fibo extension taken from the low of 13th of January. So i.e. in the flip shell, because of the bearish momentum that is being depicted on the hourly RSI, we will flip to a intraday bearish bias for today for a potential minor pullback setback scenario on the sterling dollar using 1.2720 as my short-term pivotal resistance level. Okay, next up will be the Aussie dollar. Like I explained, the Aussie dollar continues to remain weaker than the sterling and the euro because of its direct correlation with the Canada dollar, which is weak as well. So with that, it's now trying to play around the 63.30 level again during right now as you're speaking. So with that, I do not want to still, because there's no clear break unless we have a clear break after at 2 p.m. or mark or so, which is the start of the European session, then I could tighten the key short-term pivotal resistance to 63.70, which is the first, okay, which is not okay, which is this level here, 63.60, this level, 63.65. All right, 63.65. So unless it has a clear break below 63.30, I will tighten the short-term pivotal resistance to 63.65. For now, still remains at 64 figure level. Why 64 figure level? Very important. If I go to the daily chart, you'll see it very clearly. So this is a daily time frame chart over here. So this 64 figure level is in fact the previous major ascending trend line from 13th of October 2023 low, where it broke down on the 10th of December, indicating a bearish breakdown of the price action of the Aussie dollar after continuing to trade within a 1 year plus of sideways range configuration. And right now there was a retest to it, a series of bearish reaction of it in the last 1, 2, 3, 4 days in a row. All right, so this is a very clear level, 64 figure level. If the bears cannot surpass above, if the bulls can't surpass above it, there could be a big risk that this rebound over here from the low of 3rd of February all the way up to last Friday high consider as a corrective rebound sequence. That means a dead cat bounce within a major downtrend phase that is still intact on the Aussie dollar. So that's on the daily chart. So on a intraday basis, we are still taking things one step at a time. Like I mentioned, only a breakdown below 63.30, then I would tighten it, the short-term pivotal resistance to 63.64. All things remains the same. Below 63.30, see 63 figure, followed by 62.70 next, one step at a time. 62.70 represents also the 50-day moving average, I think as a similar support level at 62.70. Only a sudden rally up and the hourly close above 64 figure level, then all bets are off for the bearish scenario to take hold, and it will flip back to the bulls to expose the next near-term resistance in first step at 64.30, followed by 64.70 next. So that's for the Aussie dollar. Onwards, next will be the Aussie yen, and also the dollar yen, pardon me. So the dollar yen yesterday, we do have a bearish bias. So the bearish bias, once again, hit our first support level at 48.80/70, managed to survive it during the start of the US session, and as well as the start of today's Asia session as well after the retest on it. And right now, very interestingly, after we start to see lower low yesterday in terms of the intraday shadow, the hourly RSI starts to shape a higher low, which is a bullish divergence. So with that, we will now be more dynamic in our approach for the dollar yen. We will use 148.80 for sure /70 as our short-term pivotal support for today, because of this bullish divergence and the strong significant retest of it in today's Asia session by forming a second hammer candlestick formation. After the first hammer candlestick formation has taken shape on the US session yesterday, we will flip to a intraday bullish bias again on dollar yen to be dynamic in the scenario to potentially see a mean reversion rebound taking shape on the intraday basis. First resistance level to watch, pardon me, 149.90. Above it sees the next resistance zone coming in at 150.70/95. Only a sudden push down and a breakdown below an hourly close of 148.70. Short-term pivotal support. Today's intraday mean reversion rebound scenario will be invalidated to see the continuation of the impulsive down move towards the next near-term support level 147.95. A breakdown below it exposes 14710/14690, which cluster with a previous minor swing low area over here, and as well as a Fibo extension level as well. Right, so with that bullish divergence that's being seen and the positive price action that I highlighted earlier on the lower limit of this medium-term descending channel that is in place since the high of 10th of January this year, we will flip back to a intraday bullish bias for a potential intraday mean reversion rebound scenario to take hold using 14880/70 as my short-term pivotal support level. All right, so that's for the dollar yen bounce. All right, so with that, there's a particular FX cross pair I want to highlight for you guys, will be the Aussie yen. Okay, so with that, previously yesterday I highlighted CAD yen. So CAD yen actually tumbled and hit our support level at 104.8/103.95. All right, so now the next yen cross pair that hasn't really broken down so far against the CAD yen was the one that's quite steep. The next one will be the Aussie yen over here, but Aussie yen, there could be a risk of a bounce as well because of the dollar yen. Just now there's a minor rebound, so this bounce that could take shape on during the start of the European session, do look out for a potential bounce. But after the bounce take hold, potentially look out for any signs of bearish candlestick formation right below the 94.40 short-term pivotal resistance that I highlight for you all today. So as long as there's no push up and hourly close of this potential minor bounce that may take shape during the European session, as long as it didn't surpass above 95.40, we will potentially have a bearish bias on the Aussie yen over here. First support level to watch out for will be the minor swing. Okay, the minor swing low of 94 figure level in yesterday's US session. A breakdown below 94 exposes 93.65 next. All right, so that's for the Aussie yen. However, a push up above 95.40 with hourly close above it, that would negate the bearish tone on the Aussie yen to kickstart a mean reversion rebound sequence on a minor time frame basis, exposing the next near-term resistance at 96.05, which correspond to the downward sloping 20-day moving average as well. So this is one of the potential FX cross pair to highlight for today will be the Aussie yen. Yes, bearish bias, but potentially we may see a minor bounce first, as long as this minor bounce didn't surpass above 95.40 short-term pivotal resistance for today. Potentially the Aussie yen could still shape another potential down leg with the near-term support level to watch, 94 figure, followed by 93.65. Okay, so that's for the Aussie yen. Onwards next will be the outlook, intraday outlook, technical outlook on the major stock indices, starting with the Hong Kong 33 that is representing the Hang Seng Index. So still remarkably strong, rebounding, going against the performance of the US major stock indices that I mentioned earlier on at the start of today's daily dose. So still no change because it can't surpass above the first resistance at 23,830 over here. Unless it could surpass, then I would tighten the key short-term pivotal support level to this level here at 23,220. All right, 23,220, unless you could have an hourly close above it. So for now, still using the 22,880/760 as my short-term pivotal support level on the Hong Kong 33, representing the Hang Seng Index, maintaining that bullish bias for that continuation of this impulsive upmove sequence to resume above or to continue, pardon me, potentially above 23,830 sees 24,190/510 next. All right, 510, this next resistance zone next over here. However, if there's a sudden U-turn and where price action broke down below 22,760 with an hourly close below it, this will invalidate today's intraday bullish bias to kickstart a minor mean reversion decline scenario or setback, exposing the next near-term support at 22,470, followed by 22,130 next. Okay, so that's for the Hong Kong 33, still maintaining the intraday bullish bias. Onward next will be the Japan 225 over here. So the Japan 225, yesterday we do have a neutrality stance and price action broke below the neutrality limit at 37,980 and hit the next support level at 37,730 next over here. So with that, what we could see over here is that the price action continues to remain rather lackluster. So what we could see is that the hourly RSI continues to be kept by this descending trend line. All right, so with that, I will use 38,310 level, which is the minor swing high area of 25th of February that saw this steep decline yesterday. This is the inflection point that saw this steep decline or trigger this steep decline yesterday during the US session, and as well as this 28,310 also confluence with this minor descending trend line that I drew from the high of 18th of February. So as long as 38,310 short-term pivotal resistance is not surpassed on the Japan 225 representing the Nikkei 225, potentially there could be a retest on 37,730 next. Again, a breakdown below it exposes the major range, complex range support level at 37,415. So if you go to the daily chart, you will know what I mean. So this 37,415 is very key because it's the lower boundary of this complex range configuration that has taken shape since late September last year. So this will be the key support level to watch once price action touch this level, all right, to see whether there's any form of potential bullish reversal that could take place next. Only an hourly close above 38,310 will invalidate today's intraday bearish bias on the Japan 225 to see a potential squeeze up to revisit 38,800, which also cause confluence with the 200-day moving average, acting as a similar resistance area as well. So that's for the Japan 225. Next up will be the German DAX or the German 30 continues to remain resilient, holding above the 20-day moving average and continues to see a series of higher low on the hourly RSI above the 50 level mark right now. All right, a series of higher low above the 50 level mark right now, indicating that positive momentum on the intraday basis still potentially remains intact on the German 30 or i.e. the German DAX. So still no change because it hasn't broken above the first resistance zone of 22,714. I don't want to tighten my key pivotal support level to be so tight, all right, over here. So I will use this level here as my first support level to watch, 22,305, unless it can have a clear break above an hourly close above 22,714, then I could tighten my short-term pivotal support to 22,305. So at this moment still remains 22,130 as my short-term pivotal support level, also confluence with the rising 20-day moving average, still maintain that intraday bullish bias for the next impulsive upmove sequence that may unfold, revisiting the next resistance level. Next will be the swing high, the current all-time high area at 22,930 / 23,050 next. However, an hourly close and a breakdown below 22,130 will invalidate today's intraday bullish bias to kickstart another round of mean reversion decline scenario, exposing the next near-term support zone in first step at 21,690 / 21,540 next. Okay, so that's for the German 30. What's up for the US stock indices, starting with the US Wall Street 30 representing the Dow Jones Industrial Average over here. So what you could see over here is that the price action continues to remain trading in a sideways range, all right, over here. So what you could see over here is that I will be maintaining that neutrality stance for now. Okay, I don't want to be so aggressive. I have to be bearish over here or bullish. Okay, so let me change it again on the Dow Jones Industrial Average, the Wall Street 30. So I said it tested the lower limit of the neutrality zone that we have yesterday 3 times. Okay, 1, 2, 3. In fact, fourth time in the fourth time, 1, 2, 3, 4. Right, and also fourth time as well at the upper limit. 1, 2, 3, 4. All right. So with that, still maintain a neutrality stance between this neutrality zone for the 3,730 / 840 and for the 3,380. Only either a breakout of these two zones over here, then that could validate a trend, intraday trend bias direction. That means i.e. only an hourly close above 43,840, then potentially we'll see a bullish bias. Next support, next resistance level to come in at 44,190, and only a breakdown below 43,380, then we could see a bearish bias for the next support level to come in at 43,120 / 42,980. So for now, still maintain that neutrality stance on the US Wall Street 30. Okay, next up will be the Nasdaq 100. So the Nasdaq 100 yesterday we were a bit bullish. at this 21,220 to look out for a potential bounce. Yes, the bounce did take shape, but it falls short of our expectation, because the next resistance level to watch on the bounce will be at 21,570, but it not made. It hit at 21,400 before shipping is pushed down and broke below this minor descending trend line from the low of 13 of a medium term descending trend line from the low of 13th of January 2025. So with that, it seems to us that the bearish momentum still remains intact on the Nasdaq 100 given yesterday's price action. So using yesterday's inflection level that triggered that steep down move during the US session, 21,400 level. So that also, yeah, that will be my key pivotal resistance level for today. I will flip back to a intraday bearish bias on the Nasdaq 100. 21,400. First support level to watch for today will be 21,030. Breakdown below it exposes the next near-term support zone at 20,910 slash 20,790, which is the minor swing low area of 3rd of February and 27th of January, and as well as the 1.368 Fibo extension of this ongoing minor decline that has taken shape since the fresh all-time high on last Thursday as well. Only a push up with an hourly close above 21,400 will invalidate today's intraday bearish bias to kickstart a mean reversion rebound scenario, revisiting the 50-day and the 20-day moving average again, both of them confluencing with graphical support level at graphical resistance level, pardon me, at 21,570 and 21,740. So i.e. In a nutshell, we will flip to a intraday bearish bias on back to the intraday bearish bias on the Nasdaq 100 using 21,400 as my short-term pivotal resistance level. All right, so that's for the technical outlook as well for the major stock indices. So now let us turn our focus to the commodities market, starting with this Gold XAU slash USD. So for Gold XAU slash USD, yesterday price action broke down below the 2003 or 3 short-term pivotal support that I highlighted. And what you could see that the technical configuration on the hourly RSI also has been bearish as well, starting to actually broke down and right now continues to print a series of lower high below the 50 level mark. So with that, there could be a risk that right now Gold XAU slash USD is doing a bit of extreme, okay, no, it's a earlier optimism, bullish positioning unwinding on the short term basis. So with that, I will flip to a intraday bearish bias for Gold XAU slash USD, but the medium term trend and the major uptrend still remains intact, using 2,954, which is the current all-time high area, as my short term pivotal resistance level. First resistance level to watch will be at 2,930 that got rejected right now in the Asia session. First support level will be 2,880, which correspond to the lower limit of this former medium term ascending channel from the low of 31st of December, and as well as the rising 20-day moving average that is acting as support at 2,880 as well. Only a breakdown below 2,880 may see the extension of this mean reversion decline scenario to unfold, exposing the next near-term support at 2,845. Only a push up with an hourly close above 2,954 will invalidate today's mean reversion decline sequence to see the bulls reverting back in force for the next near-term resistance zone to come in at 2,990 slash 3,000 because of the weakness, technical weakness that's being seen on the hourly RSI right now, indicating the lack of upside momentum, and potentially there could be some positioning unwinding of what I call late optimistic long position on Gold XAU slash USD, that we may start to see a potential mean reversion decline sequence on a minor scale first in first step, using 2,954 as my short-term pivotal resistance level for today for Gold XAU slash USD. And lastly will be the West Texas crude oil. So what I could see over here is that the West Texas crude oil on a daily chart, there's a big plunge of negative 2.6%, and right now it's looking to retest the 67.55, 65, 67.55, 65.70 level. So this is the medium-term pivotal support zone that is still in place since March 2023 minus 2023 swing low. Right, tested a lot of times over here. All right, so what we could see on the intraday basis, we were bearish yesterday, and price action continues to plummet over here. No signs of very clear potential bullish reversal that may take shape. Why? Because the hourly RSI does not shape a bullish divergence. Yes, it's oversold. Potentially there could be some signs of minor bounce taking shape for today at the in first step. So as long as this minor bounce thereafter didn't surpass above a tighten short-term pivotal resistance for today that I have on West Texas Oil, which is 70.40, we will still maintain that intraday bearish bias. Next near-term support level to watch 68.80, a breakdown below it exposes 67.96, which is the minor swing low of 10th of December. However, if the minor bounce extended and surpass above 70.40 with hourly close above it, today's intraday bearish bias will be invalidated to see a much more deeper mean reversion rebound scenario unfolding again for West Texas Oil, exposing the next near-term resistance at 71.35. Above it sees 72.10. We also correspond to the downward sloping 20-day moving average. All right, so with that, yes, there could be RSI oversold, so there could be a risk of a minor bounce taking shape. So as long as this minor bounce didn't surpass 70.40 tighten short-term pivotal resistance level on West Texas Oil, we will still maintain that intraday bearish bias for West Texas Oil. All right. So with that, that's also sum up today's we call it intraday technical outlook on the cross asset classes. So before we go, we know that today's key risk level pertaining key risk event pertaining to the US stock market, especially S&P 500 and the Nasdaq 100, which I explained earlier on, is NVIDIA. All right. So NVIDIA over here will report its earnings, Q4 earnings of last year at the close of today's US session. That means at 6 a.m. Singapore time tomorrow. That means 27th of February, Thursday, 6 a.m. Singapore time. All right. So market analyst is expecting a 60% jump on EPS, earnings per share. That's rather high. So to be precise, if you look at the economic calendar, market is expecting a EPS of 0.84. But what market is also looking at is the forward guidance of the senior management of NVIDIA, especially on their high-end chips from demand from its key customers like Alphabet, Google, Meta, and as well as Microsoft in training their AI related business model. So market want to hear how's the forward guidance on this higher end chips will be for the next quarter. So that could potentially drive NVIDIA prices and potentially will lead to a significant movement on the Nasdaq 100 and the S&P 500 as well in tomorrow early Asia session. So other economic data to watch other than NVIDIA earnings result for today will be GfK consumer confidence in Germany, so that could potentially drive the German DAX and as well as the euro dollar. So that will be at 3 p.m. Singapore time thereafter. And what we could see at 9:30 p.m. we have a Federal Reserve official banking speaking. Then thereafter, no clear tier one economic data to take note of, except for this is more pertaining to the weekly EIA crude oil stockpile change that could potentially impact the intraday movement of West Texas Oil. So that will be out at 11:30 p.m. Singapore time. And thereafter, at 12:30 a.m. Singapore time, we do have Bank of England officials, Digra speaking. 1 a.m. Singapore time, we have Fed Bostic speaking. All right, so that should that sum up today's daily dose of market insights. I'm Kelvin here signing off. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.